If this is your first time listening to pre-market prep, take it with a grain of salt. If you're a long-time listener and you think these guys are absolutely crazy, your thoughts have been confirmed. We got some great subjects today to cover. Some in the media, some related to the price action yesterday in Schwab and RJF. Tons of earnings to cover. Some good, some bad, some really bad. Joel Kulina, top guest, Wedbush Securities, joining us at 8:35. And did I forget there's a jobs number at 8:30? Let's see if we can stay under 10%. Folks, it's hump day on pre-market prep.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
Man, very quiet here in the S&P 500 index futures. Just sitting here at 69.67. That's up 5.5 handles. Well off the low and the high of the session. The buck, that's down 7 cents here. A little bit of a decline here over the last 3 days. TLT flat, 88.56, popping ahead of the jobs report. USO up 76 cents, gaining a bid towards 80. GLD and SLV both on the move. GLD up $5, 467.50. SLV, that's the big winner. That's up 6% here at 77.34. 4% maybe with all these quotes flashing around off the 8 p.m. Bitcoin, 70K. Is 70K the new 80K? Resistance at 70K here, $1,725 in the red at 67,210. These charts to you are brought to you by TradeStation, born to trade, chart, analyze, customize, all in one platform. Learn more about TradeStation. So here we are, Triple D. I have to say that's been one of the most invigorating pre-market prep shows we've had in a long time. You're fired up, Triple D.
Yeah, lots of good discussion. I want to bring Brent into this conversation here too. So welcome to the Brentster in.
Good morning.
Lots to think about. And I mean, the title of this show, AI's Next Victim, I am predicting, official prediction here, is that this title of this show is going to be able to be used at least 25 more times this year. AI's next victim. And I think we're just going to continuously cycle through like, oh crap, that's getting disrupted too. Oh crap, that's getting disrupted too. It's an interesting conversation. And we're going to start this with yesterday's victim, which obviously if you're watching markets yesterday, you know. Yesterday we saw LPL Financial, which is LPLA, Charles Schwab, Morgan Stanley, RJF, stock companies that are very much have a financial advisor role there, where obviously you got financial advisors that are doing everything from investing to, planning, your wills and stuff all the way through, taking all the way through. We all of a sudden discovered yesterday that AI might be able to do this job. Not shocking, but not obvious to a lot of people because RJF, LPLA were doing fine until yesterday. So, there was, obviously one company came out with a product, looks like it might disrupt them. We don't need to get into the details. It's the point of the discussion, though. Like there's a bigger discussion happening here. We see this, we saw this a couple times last week, a couple times the week before, and it's going to be the theme through 2026, that there's going to be AI disruption happening to a lot of industries. Financial industry looks like an obvious one too. I mean, not as obvious as software, but, these full financial services, I mean, a lot of these businesses have been disrupted for a long time. I mean, a lot of these companies were brokerage businesses, like Charles Schwab, like with big commissions. Think about like to the 1990s, Joel, when you were paying $100 for a trade or 1% of, the cost of the trade, sometimes thousands of dollars for trades in the case of, some of these biggers. These companies and banks did reinvent themselves, and they lived through, a lot of people predict that Robinhood would knock these companies out of business with zero, commission trading. Or you said Oldie, obviously started with it as well. They lived through all that. This companies have gone up. So they may live through all this too. But yesterday, there's nervousness around AI potentially disrupting this industry as well. So just scorecard so far. We saw AI originally, coming out and software stocks going down. And we saw gaming stocks going down. We saw companies like Expedia, going down. So again, software. Pardon me, Brent, what was the other one?
Booking,
Expedia
right,
going down because AI is going to disrupt. And then now we're seeing the financial services, like full financial services, possibly getting disrupted here too. So where does it end? Is it done now? Is that it? Is that all there is? Unfortunately, probably not. There's an article going around this morning, was published yesterday from Matt Schumer, but it's got now 21 million views on X. So you could say it went viral when it's got 21 million views.
Mm-hmm.
Something big is happening is the article. I couldn't read it in detail because I was this morning, but I glossed over most of it here. Joel did a nice AI summary of the article, so we can AI the AI article. Basically, he's comparing AI to like the summer of COVID. When COVID was coming, we knew that virus was coming. It was going to come and basically, shut the whole world down. He's line in the article here is, I think we're in this seems overblown phase of something much, much bigger than COVID. So saying a lot of bad things through the whole thing. There's some good stuff in there too, but basically jumping, and another conclusion in there is we talked about the 50%. We mentioned this last week about, the one gentleman who said that 50% of white collar jobs will be gone by the year 2030. In the article, he says that is very conservative. He thinks that a lot of people may even lose their jobs by the end of the year, that AI is moving so rapidly now, where 3 years ago, it couldn't do a basic algorithmic function, saying it didn't know what like 7 times 8 was. It would say it was 54. It was screwing that up. And then you have people who used AI last year saying, look, this isn't great. It makes mistakes. He's like, it's getting to a point where the mistakes are getting fewer and far between. So it's come a long ways from last year to this year. Now he says AI is just like basically doing jobs from start to finish, like, project creation. It's like, imagine wanting to write a book. I've always wanted to write a book. You don't have time to do it. AI will just write the book for you. So, I mean, this is like, obvious stuff here too. But then going into, other jobs and talking about like potentially 50% of white collar jobs being gone. I mean, there's a lot of things to worry about here. Is it all just worries? Maybe. But at the same time, the market is pricing for some of this stuff. This is why software companies got killed. This is why we saw the gaming companies. This is why I saw the financial companies. So, us as traders need to be on top of all of this stuff because this stuff moves markets. Does this have the potential to move markets as well? This article in itself? I think so. I think it does. Going viral here this morning. I think people are talking about it. I think people are nervous. I think it gets people thinking. So lots to think about. Like, does this we're all out of jobs and we're all dead? No. But it does mean that the workforce is going to significantly change. Facebook talking about flattening their workforce means getting rid of jobs. Amazon talking about getting rid of jobs. I think we can safely say, and I can say this not with 100% certainty, nothing's 100%, but with 99.9% certainty, I'm going to say today that AI is going to create a lot of jobs, but it's going to take away way more jobs than it creates. There is going to be more unemployment 3 to 4 years from now. I am very confident in that.
Yeah.
More unemployment. What does that mean? Well, we're not just losing uneducated blue-collar jobs. We're talking about losing white-collar jobs. We're talking about losing upper-class jobs. So what happens, and again, feel free to chime in the discussion in the chat here because we're just thinking out loud. But this, if you've got the upper class that's spending, people making $200,000-$300,000 a year, spending freely, they basically have financial freedom. All of a sudden, lose their job, and now they can't just get another job right away because that AI has displaced this entire industry. Those people now all of a sudden need to start saving and spending less. So does that mean, stocks go, if we lose spending, does that mean stocks fall off a cliff? Not necessarily, because efficiencies are going to be much better in companies. Like if you have a flattening workforce here, like where you're actually losing jobs, you have less expenses too. So you could probably sell less product and maybe even make more money. Now, which brings us to this conversation, is consumers are still going to consume. But if you take some upper class jobs and move them and get rid of them, people move down to the middle class or even to the lower class, like I'm saying, just people making less money. People are going to stop doing discretionary spending and start doing more like basically just necessity spending. So this rally, which I have said Walmart makes no sense. I've said this on the show for the last like 3 months. Makes no sense trading 40 times earnings. Maybe in the context of AI, it does make sense. Because if you're going to have a trade down effect, we know Walmart is where, if you're just trying to make ends meet, Walmart is the place where people go. If there are going to be more people that are going to have to make ends meet, people that just had free spending before, but all of a sudden, are tighter for money because potential job losses, then all of a sudden, Walmart starts to make more sense that, hey, this is a company that people are going to spend more at. So you start thinking about like more necessity spending. What are necessities? It's food, clothing, shelter. Those are your necessities. That's all you need in this world to survive. Now, we're not saying, that, the end of the world is here, but we're saying if we think back to COVID, what stocks really did well during the whole COVID, like lockdown there? Necessities. People were going out and buying things that they absolutely needed. Toilet paper, like stocking up on food, groceries, drugs, whatever they were stocking up on. And we're not saying batten down the hatches that the world's ending here. What we're saying is that necessity spending may increase. And if necessity spending is increasing, then companies like Walmart at 40 times earnings starts to make some sense. So I want to get your guys' thoughts here as well, because I've been ranting about this for 5 minutes. But I'm just laying it out. Chat, I want to know you as well. But maybe, just maybe, the staples, which have been relentlessly going higher, and we've chalked it up to rotation, maybe the staples is actually an AI play.
Well, let's bring in the job situation. We get jobs data at 8:30 today, right? That's a very important thing. And I'm looking at Kelsey here. How high will unemployment get before 2030? Above 8% right now, there's a 56% probability. Above 9%, 43% probability. There you go. I mean, so there is a trend. I mean, at least we're seeing in the prediction markets. Of course, anything can happen with that. But I mean, that's that's the important thing. Now, what we're being told by AI is that, well, people, they're going to have more time to make money doing other things. Well, they need a job. People need jobs. So this is the impact on the market. It is, very hard to, predict that far out. We can get the data, we can get the numbers. We all know a hell of a lot can happen between now and 2030. But I want to bring the discussion in is like how to play this, right?
Yeah.
And I will just say, for these stocks, I'm just going to use Schwab up here. I mean, that's a warning candle. That's an ugly candle. That's I don't know if it's, start of it's the end, but that's a warning candle. When you get that kind of heavy selling on that kind of volume, I think the volume absolutely blow it away. If you have been in this, you're a long-term investor and you haven't paid attention to any candle, pay attention to that candle.
Those are warning candles. Like, I don't know if they're officially called that, but those actually is a fantastic name for that candle, Joel. When you see a stock at an all-time high and it has the violent, sell-off, and again, you can say, well, I'm killed on it. Well, you're not. The stock is where it was, 3 weeks ago. But that's a warning that, hey, we are now on the radar for disruption here with Charles Schwab. It's like a stock that's been going. Now you've got a warning that this is maybe, and again, warning candles get bought. People are like, oh, this is irrational. I'm just buying this dip. They were buying it yesterday. So I love that name, warning candle, Joel. I love that name because I think we're going to see more of this.
Yeah, and along with the other financials that you mentioned, LPLA, they all look the same. I mean, that doesn't look as bad on a monthly candle, but on the daily candle, you can see that price. Actually, that one has a low in the same area, so. And it did get a little bit of a bounce, but the 355 area looks pretty important. As far as like the Walmarts, I mean, the Walmarts, you can't argue with these charts. Colgate, Palmolive, the most boring stocks. You could just go to the XLP here. I mean, the price action in these is kind of confirming your worst fears. Whether things are overblown, only time will tell. But that XLP, I mean, you don't see many moves in the XLP like that. 77 to 87 or almost 88 yesterday at the beginning.
No, this is and again, I've chalked it up on this show for the last month to this is just rotation. And I think a lot of it is rotation. It is the market was worried about software, worried about certain industries, and moving to staples, moving to safety. But if this really does occur, if the Schumer article ends up being correct, and we are going to lose potentially 50% of white collar jobs by 2030, and he said that was a conservative estimate. What does that look like? Like if that ends up, and these are scenario analysis 4 years. He said it could happen sooner in the article. The article's scary. He says it could happen much sooner, and he thought a lot of people could lose their jobs within 2 years. If that happens, big if, maybe it doesn't happen at all. But there's a lot of writing on the wall here. Just like with COVID, Joel, me and you were on this show, go back to January 2020 and preaching that this is coming and it's going to be a reckoning. And we were buying puts. And I never buy puts on my long-term portfolio. But I was hedging away, selling stocks and buying puts on my long-term portfolio because I was worried about a reckoning day. We were buying puts on airlines, cruise lines, remember, because we thought the world was going to shut down. And I went out to February and I didn't go out long enough. And then I'm like, screw this, I'm going out to June the next time. And then I got paid. March happened. We dropped 30% March. It was so obvious. Like people who were just like not talking about it had their head in the sand. This is the same thing. He's right with the analogy.
I don't know if it's the same thing, Dennis. I don't know if it's the same.
You don't think AI is going to cost jobs?
It's going to cost jobs.
That's all I'm asking.
Is it going to kill people? Is it going to kill people?
No.
Is it going to totally?
Nobody's talking about that, Joel. The article simply says that many people are going to lose their jobs.
I know, and I'm saying to compare this to COVID, which was a disease.
No. You're missing the analogy. You're missing the analogy. This isn't a disease. This is an analogy saying there's a reckoning coming that we can clearly see. We're using COVID as an analogy, not as like there's another disease coming, Joe. Follow us along. This is an analogy only, saying that we could see COVID coming for months before it happened. We can clearly see there is a reckoning for jobs coming. There is going to be a lot of people that lose their jobs. This is not like, oh, we're guessing. This is obvious. So we're going to get jobs numbers in 13 minutes. But what does it mean when a lot of people lose their jobs? This is the question. It's going to be like more efficiency for some companies. But I do believe necessity spending increases. We've seen this with COVID. We saw what happens, when tough times happen. So if this is happening, if we are indeed going to lose, and it's not like Schumer just all of a sudden said, something that nobody was talking about. He just put it all on paper. We've been talking about this stuff. Everybody's been talking about this stuff. Obvious guy trade says that unemployment is going to go up. That's the obvious trade. So, how do you make money with that? How do you trade that? Because that's our job as traders. We're not in here like, again, we can talk, from philosophical humanity perspective here, but people are here listening. How do you make money from this? I mean, staples is definitely a possibility here. Like Mitch is saying, car loans won't be repaid. I mean, yeah, default, going up, defaults like on debt and stuff. I mean, that's a possibility here too. There's this discussion is everything. Like we can talk about like, an earnings report like Robinhood. We can talk like an earnings report. We can go on this. But this overall discussion is everything. Like this is where we are heading here now. There's no stopping it. You can't put the genie back in the bottle and say, uh-oh, we screwed up. A lot of people are going to lose their jobs. We better stop AI. It's going exponential. It's going to do things next year that we couldn't even dream of it doing. It's only going to get better. So who are the clear winners here? Let's just start talking stock picks here because it's important. And Joel Kulina is going to come into this discussion 8:35. So this discussion is going to continue. But clear winners, obviously NVIDIA is a clear winner. Clear winner. No-brainer winner. I think AMD is a clear winner. I think hardware, clear winner. I'm starting to think clear winners are the staples. I never thought of the staples before today as an AI trade, but I'm starting to think of it because if you think out 2 to 3 years, people are going to start buying more necessities. So maybe these rallies in Colgate and Coke and Walmart make some sense in the big context of things, that it's not just rotation, it's actually people positioning for job losses, major job losses in the future. That's something to think about.
This is one of the most polarizing topics that we discuss on pre-market prep. The chat always has, some strong opinions, just like the guests, the hosts do too. The AI gets defense a lot in this way, talking about the adaptability of humans, and I get that. Also, humans are pretty darn lazy. I think a bigger thing than the adaptability of humans is like, how is the job market going to be changing? We're talking about a major dynamic change in the job market. The one bit of X factor that we haven't mentioned on air yet is you can't put the genie back in the bottle, but can government step in to do some kind of regulation? I don't know where I don't know where the opportunity is in that for a trade, but maybe we can have things on our radar to consider that we just don't know the answer to.
Government will definitely step in to regulate as much as they can, but the one problem is there isn't like a world government. So you can put US regulation, Canadian regulation, we can do all this, but it's not going to stop AI from developing in another country, and then all of a sudden you fall behind. I mean, it's not like we have a world regulator here. We don't have a world regulator to like regulate AI. So I just don't think regulation is going to stop it. I think we have to accept it and then adjust for it. That's really what we have to do. Is with AI, we have to accept it, that this is here, this is going to replace a lot of jobs, and we have to adjust for it. I mean, we've saw the software stocks get relentlessly hammered. They've had a relief rally in the last couple of weeks, people saying it's overblown. We're going to get Joel Kulina talking about this as well. Is it overblown, though? That's the question, because, a lot of these services, software companies, software as a service, we know AI can maybe do some of these businesses here. So maybe the Salesforce, which we can look, and we've had a pretty good rally in a lot of stock. Yet Salesforce sits down here, barely rallied. Barely rallied. Like we've had a pretty good rally in Microsoft. Maybe they're going to figure it out, but barely rallied Salesforce. Workday sitting right down there, the low. ServiceNow trying reluctantly to rally here. But software as a service has major problems here. We saw yesterday with the financial services. Like there's different industries that are going to get disrupted. But if jobs overall are going down, consumption is going to be disrupted too. There'll be less consumption overall. So it's all going to be about efficiency in the future. I believe it's going to be a major topic for companies to continue to make the kind of money they are. It's going to be about efficiency. And if you've got a company and you're selling stuff that people don't necessarily need, I mean, it's about efficiency, and obviously making just the same amount of money or more money by having less employees and less staff. So I don't know if necessarily the stock market tanks on this. We're not saying that. What we're saying is with jobs going down, it's going to be clear winners and clear losers. And this theme of AI's next victim remains and will continue to remain for a long time here. There's going to be continued new victims. I think jobs eventually are a victim too.
Just to say the other side here, if you think that what we're discussing here, what Dennis is concerned with, and maybe a lot of other traders are concerned with, if you think that these are overblown, I think you know where the opportunity is. It's in some of these beaten down spaces, software certainly, that have been under extreme pressure. So if you think that a lot of these fears are overblown, we're also pointing you in the direction of where that bit of a contrarian thought process.
You can bet on that. If you think it's overblown, Brent, this is a fantastic point. If you think it's overblown, you're buying Salesforce, you're buying ServiceNow, you're buying Microsoft, you're buying those names. If you believe it's overblown, I don't think it's overblown. I think the market is right. And I think these stocks are sells on rips. Sorry, that's my thought process. I don't have a crystal ball. I could be very much wrong. I'm wrong. Am I trading? Probably 47, 48% of the time, but if I'm right 51 or 52, I make a lot of money and I make my living. But I mean, this is such a polarizing conversation because people don't want to think about losing their job. They don't want to hear that, this is like AI could potentially replace me. They don't want to hear about this. So it makes people mad. It makes people upset. But you know what? Reality bites. It does. This is a reality check here. This is where we're going. Some people have already lost their jobs. I mean, it's not like we're guessing. Facebook's talking about, like, Amazon's doing it. I mean, this
their
flattening
units.
word, you're going to hear this flattening word again and again and again. We're going to get some jobs on this day, and the jobs might just be fine because it's backward looking. And you say, oh, Dennis didn't know what he was talking about. Look, jobs were great. But this is showing up here in the next 2 years. This is going to start to show up. At least that's what Schumer believes. And I think he's right. I think we're going to have a lot of job losses coming. And what that means for, the stocks is winners and losers. Stocks that sell necessities like Colgate and Walmart. Walmart is the necessity store. It's the necessity store. People go to Walmart because they need this stuff. I mean, that makes sense. So you start thinking about Walmart 40 times and it doesn't make any sense. Maybe it does. Costco is the necessity store. Costco is probably a buy. The necessity store. Is Target the necessity store? Yeah, kinda. Maybe you can buy on a Target here. Actually,
Target's been on a roll.
Been on a run here, and it's been on a run because the company actually benefits from AI because it's a necessity store. Necessity stores are very important. We took this position SVV, Savers Value Village. We took this a while ago. Carmen brought it to us in the STN room. It's a thrift store. But people go in there, they want to get a deal, they want to get some stuff. But you also get cheap clothing, cheap shoes, and stuff like that. It's kind of a necessity store, too. Got a lot of knick-knack, paddywhack stuff in there. You don't need all that. But if you wanted to go get some cheap clothing, Super Value Village, Savers Value Village is a way to do it. So start thinking about investing in necessities maybe on pullbacks. Might not
look
be
at this
1150
level in your super value, Dennis. Trying to get into that gap area. This had a heck of a rally. Let's see, 1150. I don't know when his next report is, but we've been talking about jobs, right? We've been talking about AI concerns. Hit the brokers financial yesterday. We're all concerned at interest rates. We haven't been talking about the Fed and interest rates and stuff. So can we get some action off a 830 number? You know what I'm going to do? I'm going to spice things up here. I'm going to go to the 1 minute chart on the S&Ps and let's see if we get
Thanks, Joel.
Yeah, Brett loves that 1 minute. I'm not going to go to a chick chart, but let's see if I can make this a little bit bigger. I really don't care what the number is. I care about the price action. That's right. All these things that we talked about. What Dennis is trying to stress here is that there's implications for price action, right?
Of course.
How to take advantage of it. We set this up in January of 2020. We're setting it up again. We'll be wrong. We've been wrong a lot. We'll see how this whole scenario. This one might take a little bit longer to play out, but here we are. We're still up 1150 after the end of the world article by Schumer. See if you can get him on, Brent. We're up 11 handles at 69.72 and a quarter. Psychological that I know we got to 7,000 yesterday. No 10-second chart gave Fave. 7,000. We got above it yesterday. It's just a psychological number. But Brent, you want to hit us with the preview?
Yes, I do. So we're going to be getting this number in about 1:30 here. This is the January employment data. It's called the Employment Situation Report from the Bureau of Labor Statistics. This was rescheduled because of the 2026 government shutdown. We are looking for non-farm payrolls around 66,000 jobs. We're looking for private sector payrolls around 70,000 jobs. We're looking for the unemployment rate to be flat at 4.4%. A reminder, keep in mind that our January jobs data normally is a little bit of a lull because a lot of people are coming back from the holiday, certainly. And, maybe less hiring, maybe less firing. Maybe they got that out of the way in December or November. What time we got here, folks? We got about 45 seconds until this data point. We'll be breaking this news right when our January jobs data is hitting in about 30 seconds.
30 seconds. When people want to know what does Dennis going wide with his markets. He doesn't want to get picked off. If it rallies up, he doesn't want to get picked off on offers. If they hit it, doesn't want to get picked off at bids. Market makers are doing the same thing too, as well. Very quiet pre-market session here. We are the super fast algo guys are getting the number right now. The rest of the world will get it in 5 seconds. Survey says
We are waiting for jobs data. We have unemployment rate falling to 4.3%. Non-farm payrolls, 130,000 jobs. That's much higher than the 66,000 jobs expected. Private
Jobs.
sector
God,
payroll,
that is
172,000 versus a 70,000 estimate. We did get some revisions for the last quarter or for the last month, but they were modest. So little summary here, unemployment rate ticking lower and jobs for January sharply better than expected. Stock market off to the races here. Futures jumping about 10 points following that data point.
Woo! Everything I just said doesn't make any sense at all. There's no job losses. What are you talking about, Dennis? You're an idiot. You're an idiot. See? You're dead wrong. Dead wrong. AI costs 0 jobs. It's making jobs. We feel better about our lives here right now. Way too.
Okay. Just let me just give a quick recap. We did make a new high here, a new pre-market high. We need to get back over. I'm still going to use the 7,000. I know we have some other levels in there, yesterday's high and everything, but I'm just going to go to a real quick shorter term chart here. And, notwithstanding all the stuff we just said, this has been a wall and we've been consolidating here. The options are lined up here. Are we going to get this? Is this just going to be resistance again, like it's been for so long? Are we going to, in the Jim Morrison, are we going to break on through to the other side? We need some commentary from Joel Kulina, covering technology and media trading over at Wedbush Securities. Two Joels on the screen at one time. What you asked for? Hi, Joel.
Hey, good morning, guys. How you doing?
Okay, so you turned in early, and then you're like, you wanted to call in sick. You're like,
Yeah.
what are these guys talking about? Right?
It's this year has already felt like about 3 years, so it's a continuation of 25. That 2025, that's for sure. So it feels like almost every conversation I have, especially pre-market or post-market, people echo the words of exhaustion. So you're not alone out there if you're feeling the same way. It never ends in tech, that's for sure.
Getting a little static in your mic. Maybe just move it ahead. I think it's just brushing up against your beard.
There we go. Yeah, if you want to call it a beard, yeah. Is that a little better?
Yeah, perfect.
All right, great.
So Joel, we've been talking for the last 20 minutes about, this article was going around from Schumer. We're not talking Chuck Schumer. We're actually talking about this article. I just want to bring it up here again and get it right. From Matt Schumer. And he's talking about potential job losses coming in the next 3 to 4 years. A lot of job losses from AI. Talking about industries being disrupted, talking all kinds of things here. I mean, this is stuff that you've been talking about for a while too. Basically, he's saying there's going to be big winners and losers. We agree with that as well. I think you agree with that here too. Let's start with software, because this is kind of where this thing started 3-4 weeks ago, where people are actually worrying about AI now with stocks like Snowflake, stock like MongoDB, stock like Salesforce, ServiceNow, Workday, Intuit. Have all been hammered.
Microsoft can't catch a bid to save its life. Yeah.
Thoughts on software here? IGV falls 25% in the course of a week and a half. It's just an epic fall. Is this overblown? Is this warranted? I just want to get your first thoughts here, just on ground zero software.
It's definitely not overblown. I think obviously I think some of the moves we saw last Wednesday and then again on Thursday, when you see these type of 3 to 4 or 5 plus, I think standard deviation moves to the downside tends to get a little overdone in the near term. But I think what we've been seeing with software really since the launch of ChatGPT, this is year 4. I think ChatGPT launched November of 2022, caught fire in early 23. And there's just kind of, again, it feels like software, obviously there was a winners and losers camp really early on. But again, now as the cycle has continued to evolve and mature, I think where software really suffers, outside of a few handful of companies, you can't really point to significant ROI for all this CapEx and money that's being spent. And I think the biggest thing that probably doesn't get enough, attention as well, don't forget, less than a year ago, you had Musk go into the White House with a hammer or whatever, in Doge. And I think that was sort of one of the, add that as well, where people are just kind of looking at the seat-based model. And do you need to spend $10, $15, $20,000 per license? I mean, the common sense is that's going to compress significantly in the years ahead. And again, AI tools, they continue to evolve. What Anthropic's been doing, I haven't played around with them enough. I need to, but I mean, I think, and it seems like Anthropic has come out with multiple models just in 26 alone. OpenAI, came out with, Codex a week ago as well. People are raving about that. I mean, these tools are going to seriously harm a long list of software companies. So, but what we're seeing right now in the earnings season, you saw negative T+1 reactions in Microsoft, ServiceNow, SAP, big large cap names to start. And again, it's been kind of spilling down. But again, look at, Monday night, you had Datadog, ripped yesterday, infrastructure, consumption software. This morning, Cloudflare was up 15%, last I checked, tickers and NET, they're putting up fantastic numbers, 34% growth. I think the street was buy side was closer to 31%. And the call was extremely bullish. So there are names out there that are going to benefit from AI, and we've been seeing it for quite a long time. But I'm telling you, the game of going around and trying to catch falling chainsaws, you're going to lose. Like Salesforce is in the AI loser bucket right now. Microsoft, with all this CapEx they're spending, we just can't see that Azure accelerate, north of 40%. So there's a lot of frustration and they look at even an unknown name to a lot of U.S. investors, Dassault Systems. It trades over in France. It's down 20%. On AI fears. They do like custom design specialized tools that are most likely going to be replaced by AI. So software is tricky. I think you want to stick to the names where they're positioned not to get completely, evaporated. But what we're seeing here in tech, investors historically are relentless and vicious and take no prisoners. When multiples compress to the downside, just don't try to be a hero. I kind of stick to the infrastructure software. So think Datadog, Mongo, Snowflake, and then name like Cloudflare, even like Akamai, a winner on the security inference and CDN side of the business. But these application software stocks, there's just no bid. And I think, we'll see these bouts of squeezes and oversold bounces, but it feels like they're more tradable, right, versus investable.
So staying away from those. One stock that you do like on the dip is Meta. Talk to us about that.
Yeah, I mean, I think Zuck, the stock was in the penalty box for the better part, the past 3 to 4 months. As kind of spending again, people wanted more clarity and visibility around their spending and CapEx plans. Again, where's the ROI? But I mean, they crushed expectations. Their Q1 rev guide was almost 57 billion. I know the buy side was at 53 billion. Now their OPEX and CapEx still came in at the high end. But again, I think despite this massive infrastructure spend, full year 26 operating income is going to exceed 25. Just the path forward looks a lot cleaner, right? Now we know what they're going to spend in this year, and now they have the avocado model release is expected in the next month or two. I think before the end of Q1. But again, accelerating rev growth for a stock that's been kind of spinning its tires, in my opinion, goes a long way to improve the narrative. And I think we continue to see this dispersion within the mega caps. And I think you want to avoid the names where, again, they're just sort of been spinning their tires, whether it's been Microsoft, obviously NVIDIA as well. NVIDIA has been acting a lot better, the past week or so. But to me, like Microsoft, Apple story is kind of stuck in the mud as well. I think with a name like Meta, it's just a lot cleaner from here on with that OPEX and CapEx guide out of the way.
Joel, I just want to go back to the Microsoft for a second. Stock that been in portfolio for a long time, definitely well under pressure. But is like they're getting if this is AI and open AI and all this stuff is, this is where we're going, this is where the money. I mean, they have a 27% stake in that. I mean, who knows what the valuation of this is? The market just discounting? I mean, is that just hearsay, projections? I mean,
no,
what about that?
Typically, you don't see a large cap name like Microsoft move that violently on some of these investments. They have huge portfolios.
Okay,
I'm trying to think, other than really SoftBank, which is sort of the public market proxy for OpenAI and Sam Altman, not too many names tend to move on these investments. Or look at Zoom Media though. Zoom Media has a big stake in Anthropic. I think they invested $50 million a few years ago in 2023, and it's worth 2 to 4 billion. I saw. So that's, I think, that's a rare situation, which I can't remember top of my head how many times you actually see that. But if you're looking for an Anthropic bank shot, and with the valuation going to the moon, Zoom Media is probably your play there.
Okay.
Joel, we had Shopify report earnings here this morning.
Yep.
They blew it away. Like actually on the estimates, they didn't. They 48 cents versus 51, 3.67 versus 3.2. But the guidance was good. So the Q1 guidance is seeing 3.09 to 3.13 billion versus 2.95 billion estimates. Also announced a $2 billion stock buyback. We saw Shopify get hit with all the rest of the software stocks over the course of the last few weeks. Stocks went down from 170 to 110. Now has bounced significantly at 141. What are your thoughts on Shopify? Not just about the quarter, but going forward. Is this one of these stocks that are in the don't touch bucket, or is this one of these stocks that's maybe been thrown out baby with the bathwater?
I think 100% baby with the bathwater, and thankfully I have my notes that I sent you guys last night. I did say bullish shop. I think that was my number 2 right below.
I'm setting you up for that.
Yeah, so I have to make people aware. I mean, I think these are golden opportunities. When you see the kind of degrossing episodes that we saw last week, good high quality companies are going to get caught up in just the unwinds out there, right? And typically the big multi-strat pod hedge funds, when those guys get tapped on the shoulder and they got to cut their gross exposure, say if you're running 1.5 billion, well, you got to cut that to 1.1. You are selling your winners and you're covering your shorts. And there's no conversation at some of these larger hedge funds. The risk managers are there for a reason, to keep things tight. And so that's really what we saw last week. And in names like Shop, I think the report this morning reiterates a call just kicked off a few minutes ago. The bulls see it as a company that's going to benefit from it's agentic commerce as a tailwind rather than a headwind. There's operating leverage in the model as well, upside to high teens free cash flow margins, and again, just a great management team that's found a way to execute in almost all environments, and they continue to take share on the e-commerce side of things from Amazon as well. So what they're doing is just kind of fantastic, and I put them firmly in the bucket as a winner of agentic AI, similar to Cloudflare, which had great results last night as well.
All right, sticking in the category of benefit, or let's go to overdone, right?
Yep.
Take-Two Interactive, right?
Yep.
Okay, they'd have Grand Theft Auto 97 coming out or something very soon. A big catalyst. Here's a stock that just got killed this year. Ended the year near 260, dipped under 200 here. Is this another, buy the dip opportunity? Thought everything overblown on AI.
Yeah, depending on your horizon, this stock will be higher in 10 months. Grand Theft Auto 6 comes out, I think November 19th is the date for that. It's going to be the biggest game launch of our generation, of our lifetime, most likely, for multiple reasons. The last game was launched over 12 years ago. Kind of wild the time frame between the two launches, but the stock got really hit about a week and a half ago when Google's Project Genie went viral. So you saw names like Roblox get carried out, Unity, AppLovin got caught up in it, and Take-Two as well, and with the video game Re. But this is very, in our view, I think the fears around these AI world models impacting a company like Take-Two is just very overblown and kind of misguided. And again, but I think this market, what we've been seeing in 2026 especially, people have their itchy trigger finger on the sell button. It's not the other way around. And it's sort of the shoot first then ask is sort of been a consistent theme in all my chats over the better part of the past 3 weeks. But again, Take-Two, if you have a longer time horizon, my only I should have probably put it in my notes. It's just, unfortunately, the launch is until November, so there's really no urgency to go out and buy it today. But again, this is a company that has a very defensive IP portfolio, 100 million unit plus franchises, 13 titles with 5 million plus sellers, and then 3/4 of the bookings comes from recurring spend as well. So it's very resilient versus AI-driven content. And I think some of these AI models that we'll see be rolled out, and they are going to be coming, they're going to be more impact the likes of Unity, which is getting destroyed this morning as well, and Roblox as well, right? Roblox is not known for its graphics, whereas these AAA publishers, it's pretty tough to replicate what they built over decades of their franchises.
I mean, talk to Unity for a second here. Just stop there, because obviously the stock a week and a half ago was sitting up at $40, not much going on. Then all of a sudden we had, I believe it was Genie, come out here, and stock tanked hard. They come out with earnings this morning. The earnings were fine, 24 cents versus 20, 503 million versus 491 million. The guidance a little bit light, and I think that spooked some traders. 480 to 490 million in Q1 sales. Estimates were up at 493. But the stock is absolutely getting hammered here again,
destroyed,
down 28%. This stock has been cut in half in 8 trading sessions. Is this warranted? Is there any hope for Unity shareholders, or is this the don't touch bucket?
I mean, again, it depends. If for maybe a balance, you want to use $20 as your stop loss, go for it. I can be honest with you, that's sort of not my strength, is buying blowups. But the problem is this story is going to have a lot of hair on it. There were a lot of positive checks really late Q3 of last year and early Q4. So they have an AI-powered ad tech tool, which is known as Vector. And that was a huge part of the growth story in the re-rating when the stock went from 15 to I think it got up to $50 at one point. So you had this huge re-rating. Checks there have cooled. And then you get this sort of update where Vector came in below expectations. Iron Source remains a headwind as well. That's like kind of an ad company they bought years ago. So now the story is just full of hair. And I think, again, in the view of, I think, tech investing, you got to keep it simple. If you try to be a hero, you try to pick the bottom in a name like Adobe, Intuit, Salesforce, Microsoft, a Unity here, like good luck, because, the real tech investors just don't have any patience for these stories. And sort of that's what we continue to see. Now, we touched on it earlier, Shopify, Cloudflare, they got caught up in the unwind last week. But there was never really a shift in the fundamental narrative. So I think you want to find those stories where what has really changed here, and if you like a name and nothing has changed in your view, and do a little bit of homework, then I think those are the stories you want to buy. Like Taiwan Semi, that's a name you just want to be buying on pullbacks. Any and all pullbacks is a buying opportunity in Taiwan Semi. Again, keeping it simple, large cap, liquid, and they are truly agnostic to who wins this AR arms race. All roads go through them, whether it's GPUs, TPUs, custom ASIC chip accelerators, it doesn't matter. They're going to win, and they pretty much have a monopoly at the leading edge, which is what is needed for these more advanced AI chips.
So Joel, obviously we saw this explosion in memory prices. SanDisk, Micron, Western Digi, STX just blasting off. And there's obviously, they're huge beneficiaries, but, some of these companies that actually have to buy memory have got to be impacted by these higher memory costs. Give us a couple of those names, and let's just talk about, the memory rally here for a little while.
Yeah, I love it too. Again, that's what I love about this sector.
There's a lot of noise every day, but man, when things kind of develop in a clear fashion, right off the bat, memory prices are going through the roof, right? So if you miss SanDisk, Micron to the upside, or the storage names are seeing this wildly tight supply as well, Western Dig, Seagate. Who's on the other side of this trade? And who needs memory in their it's handset OEMs, it's video game console makers, hardware companies like whether it's Dell, Hewlett Packard, NTAP. These are your purchasers of memory, and these guys are getting squeezed hard. So there's even more negative data points about handset volumes being cut across the Asian supply chain. So Qualcomm blew up last week. I think Skyworks and Qorvo both saw negative T+1 reactions as well. But again, these aren't stories you want to be buying the dip. I think you want to be fading any and all rallies and just stay underweight these names. Look at Nintendo, right? Switch 2, launched about a year ago, had a really rough holiday season, and now they're facing higher memory prices in the near and medium term. And some of what we're hearing from these memory companies is just through the roof. There's a small company out of Asia called Winbond. They were out overnight. I mean, they expect DRAM prices to jump four times by June, and then they have capacity booked through 2027. So the supply demand environment, it's unprecedented how tight it is. And the key is supplier discipline just remains very impressive. Historically, what happens in memory, prices go up, Samsung, Hynix, Micron, they all flood the market with supply to try to gain share. Well, that mentality has shifted dramatically over the past, what feels like 4 or 5 years to me. But now we're in this situation where AI has just really just even put a bigger squeeze on it. So on the flip side, like I said, anything tied to the handsets, PCs, hardware, I would, I'd be very, very weary of getting bullish on any of these names whatsoever.
So I guess you were tuning in for talk about media trading. We will have Joel Kulina back here in a couple of weeks to talk about media. We're up against the clock here. Joel Kulina, head of technology media trading at Wedbush Securities, giving us a great look at the technology sector. Thanks, Joel.
All right, guys. Good luck out there.
Thanks, Joel. It's great.
Want to hop in and say thank you to our wonderful sponsor, Hive Digital Technologies. QR code on screen right now in the bottom right corner. You can scan that to get over to HiveDigitalTechnologies.com. Hive Digital Technologies builds and operates next-gen Tier 1 and Tier 3 data centers powered by clean energy across Canada, Sweden, and Paraguay. Hive's dual engine infrastructure driven by Tier 1 computing services and GPU-based accelerated AI computing delivers scalable, environmentally responsible solutions for the digital economy and computing, which is shaping future technologies. I don't know if you guys want to talk Bitcoin real quick, but I did want to share, we did get an updated CME FedWatch tool after our really strong jobs data. You guys want to take a look
give
at
it
that
to
real
us.
quick? Okay,
Yeah,
sweet.
yeah, let's do it.
Please.
Let me pull it up here real quick. CME FedWatch tool, always a useful tool to see how Fed Fund futures betters are pricing in changes. So June, we're looking at the June expectations here. You can see that up here in this little button right here. So for June Fed meeting, we had an expectation we have an expectation for 41%. The rate will be unchanged where we are right now. This was a change because right after those strong jobs report, we now are showing a much more likely chance that there will be a July rate cut, not a June rate cut. Looks like June rate cut expectation delayed here, folks, according to our Fed Fund futures betters. Thoughts? No thoughts?
Well, you can see the TLT trading down here. So, I mean, we can say good news for the stock market, not good news for the bond market here once again. So, TLT trading lower here. I mean, yeah, jobs are strong. What is your, we got to cut rates, I do think jobs eventually going to, I'm not changing anything that I said in the first 30 minutes of the show. I think jobs are in jeopardy over the course of the next 2 years. That is not here yet. That is not where we are right now, but it's coming. Like the wave of job losses is coming here, and eventually they will have to lower rates substantially. So I still think rates are a lot lower in the second half. I think we'll start to see, again, how much these jobs numbers, people say tell the revisions. I mean, how much, are we going to be trying to cushion the blow here when it actually does come, that we try not to make it look as bad as it is. But I think, we are going to start seeing job losses coming over the course of the next couple of years. I think that will lead to lower rates. Immediate, though, right now, no need to lower rates when those jobs numbers are that hot.
Right.
But we're gonna have our new guy in there, right?
He's a Trumpster. Trump wants it down 200 basis points.
Yeah,
200. Yeah, that's what he's asking for. So I mean, the rates are going lower in the second half. This is an obvious guy trade too. So whatever companies benefit from lower rates, you start thinking about those as well. That's why I like the regionals. I put the regional banks in my acronym. Now I don't know if there's gonna be some AI disruption in the regional banks and think that far out here. So if that happens, then it's a different story. But, there's lots to think about. Lots, we can worry about here. But right now, the stock market's worried about nothing. But there is clear winners and losers. And if you're not in the right stocks here, you're having a really rough year.
We got to cover Robinhood.
We got to cover Robinhood.
We do.
Chart on screen. I'll give you the results. Company reporting a mixed quarter. They beat on the bottom line, 66 cents versus 62 cents, but the sales weren't great. They reported 1.28 billion in sales. Analysts were all the way up closer to 1.35 billion for Robinhood. Thoughts on Robinhood chart or the report? I didn't get a chance to listen to the call, so I don't know what Vlad had to say on the call, but stock's still trading down pretty substantially. It hasn't really rebounded at all overnight.
I thought both Robinhood and Shopify were going to beat numbers. I was right on Shopify, wrong on Robinhood, and lost money on the Robinhood because of that. Made some money on the Shopify. So overall, I'm doing okay. But I was surprised of the miss on Robinhood.
Yeah.
The stock's not bouncing here either. I think the market is surprised by that. I just thought it was a low bar coming in here, but I did not anticipate a miss from Robinhood. So disappointed, obviously. I do think there's still underneath demand in a company like this, but I wouldn't be surprised if they buy the dip. But Robinhood's been out of favor for a while here now, and that's actually had a little bit of pressure on some of the other momentum names here too. So we'll have to keep an eye and see if that Robinhood can rebound from this. Important day for Robinhood though.
Oh, I wish we would have covered this at the top of the show, because the second lowest low that this stock has made in I don't know how long a time was 77.12. You dipped under 77 with the pre-market low at 76.72. You bounced $1.70 here. I think things are gonna thicken up here, especially with the market here and just full blown now over 7,000. I'd say if you didn't buy the dip, I think you're gonna have. I think the low of the day is in, so it's gonna rally up. We got a long way to go, but just like if you were jammed on this thing, or you actually wanted to buy it and you missed that move, I don't know how it got to 71.87. That was that Thursday night shellacking. But I think buy the dippers have emerged and will continue to emerge in Robinhood.
All right, let's hit a couple. Let's hit a couple ratings. Rating the Ratings is brought to you by The Fly, home for over 1,000 breaking news articles daily. The new The Fly Pro platform. Triple D and I have been using it for quite some time. We're going to get a little bit of color here from The Fly. I want to start with one that isn't like a huge priority, but there was news on it overnight. So I want to start with Beta Technologies, BETA. News overnight was that Amazon took a stake in this company, and this is like an aircraft. I think you can effectively call it like a drone company. Jefferies upgrading the stock today, and a little color here, thanks to Fly. Jefferies analysts raising the rating from hold to buy. The firm views shares as attractive at current levels, which include and a number of catalysts, which include awards expected in March, planned certification for the motor in the first half of 2026, and the start of the Eve Holding flight test program following the 10-year, $1 billion contract for Beta's pusher motors in December. The Jefferies analyst here this morning didn't even mention the Amazon stake, so that's kind of interesting. Could you guys rate this rating if you had to? You can pass. Always.
Well, I don't follow the company at all, so I can't tell you anything fundamentally about this company here. All I can tell you has been in the gutter. So you have a contrarian call. I always respect a contrarian call. Now you get the snapback rally. I mean, this thing is just from technical perspective been killed from 30 to 15, cut in half. Now you get, back up over 20. I think you got a lot of overhead supply.
Big pop. I'll just give you try and find some confluence here. Your pre-market high. How high did this thing get on the pop? It got to 21.35, and that just, if you go here, there was a couple highs in this area, right? Well, there's only one high in that area, and that comes in $22 area. So as always on these kind of things, you got the news. You want to see the follow through. If people like this one, they'll come in, they'll come bidding early. You take out the pre-market high and continue. And then the next daily high, I don't know, comes in, as I mentioned, at 22.29 if you're looking for another target. I rate this a C. I don't know. It's kind of like after the fact.
Yeah. How about this one, Joel? Baird upgrading Cloudflare, ticker NET, to upgrade following its earnings report. The firm saying the company's Q4 report, quote, marked the strongest confirmation yet that the company's growth vectors are now compounding simultaneously. The firm says Cloudflare posted record annual contract value, accelerating remaining performance obligation, and further go-to-market gains. The firm views the company's 2026 guidance as, quote, prudent, with the investment sentiment moderated and accelerating fundamentals. Cloudflare's risk reward has turned, quote, decisively favorable according to Baird. What do you guys think of this call after the fact?
I wish they would have told me yesterday.
I mean, that
Yeah,
would have been
same.
nice, but
Chase. We hate chases.
all right,
Even
let's
though
do
they maybe end up being right, we hate chasing, and this analyst fully chasing the price there.
one more here real quick, and maybe this one's probably not a chase, I would say, but you guys can tell me otherwise. ArcelorMittal, ticker MT, catching an upgrade, was it, I believe?
Well, I hate this one because I was short and I got rocked on it.
Jeffrey's upgrading to buy. Just a little bit of color. EU Steel is poised to see structurally better EBITDA over the cycle compared to history, according to the analyst, who notes that ArcelorMittal's 2027 EBITDA forecast is 15% above consensus estimates. Any rating for this one on ArcelorMittal?
I mean, you're chasing. The stock has just been on fire. Steel. I mean, let's go talk just, regular, like, what are you buying in an AI world here? I mean, if we're going to continue to build, we're going to continue to do things, it needs steel. I mean, so
sure.
It probably makes a hell of a lot of sense. Like, is AI going to disrupt the steel industry? No, it probably needs more steel. So MT, NUE, Steel Dynamics on dips are probably all buys. These stocks actually are in the AI winner bucket.
Oh, good point there. Chasing is this MT. I mean, the contrarian me is saying this thing is up $3.25 after this run. Cha-ching, ringing the register with the new all-time high coming in the pre-market 67.30. Let's see. I mean, you establish a 67 bid on this and take it up to the pre-market high. Fine. After this kind of move, if I had a 66.33 target, short-term target, I'd be like, boom, hit the bid. I'd chasing for me, so I'll give it a C.
All right, folks, we're going to go over to the STN room where we're going to get ready for the open. We'll see y'all over there, and we'll see you tomorrow on Pre-Market Prep.